What we're going to be going over here is governmental accounting for a special assessment as a serial bond here, and looking at the payments that are going to be made through the debt service fund, and also recording the general long-term debt in the debt account group here. Okay, so when we're dealing with governmental accounting, we have to set up our governmental funds here, and along with the governmental funds, we would have accounting control groups. And for our example here, we're going to have a capital project that the city is going to take on. They're going to be constructing some new highways here. So we're going to be looking here specifically at our capital projects fund here. And then along with that, we're going to also be looking at our debt service fund. This is where the debt is going to be serviced out of this fund here. And the debt service fund, this is where you're going to accumulate dollars here to pay the debt. And we're also going to be paying the debt through our debt service fund. And along with our funds here, then we're going to have our accounting control groups here. And we're going to be really focusing on our general long-term obligation, which is going to include our long-term debt. In this case, it's going to be that serial bond. We'd also be looking at our general fixed assets here, but we're not going to concentrate on that. That's simply a listing of the fixed assets that you accumulate here. So what we're going to really be looking at here is this debt service fund. Again, we're going to accumulate dollars to pay the debt, and we're also going to pay the debt out of the debt service fund for this serial bond that's going to be issued. And then our general long-term obligations, that's where we're going to be recording the unmatured principal here of the long-term debt. So the general long-term obligations for your accounting control groups here and your debt service fund, they are closely related. And we're going to go through an example looking at how those funds are related. Okay, so this is our example here. The city is to construct a new roadway, and it's going to be financed through a special assessment to property owners. What they're going to do here is they're going to issue a special assessment serial bond, and then they're going to levy a special assessment to pay the serial bonds. So the property owners are going to pay off this serial bond, or this bond here, through this special levy assessment here. So what we first have to do, we have to look at our capital projects funds. Again, this is where we account for the resources used in the construction. So what we're going to have here, we're going to be, the city is going to issue a $360,000 4-year 10% serial bond at its face value. Serial bonds are issued at face value. And it's going to be a special assessment levy here to the property owners. That is, the city's going to issue the bond and collect the money here on the bond, but the property owners are going to pay off the bond along with the interest that's due. Okay, so in our capital projects fund, this is what we're going to have here. You're going to look at your cash account here, again, for your capital projects fund here versus your other financing sources, and we're going to have that for the bond issued. So I'm laying it out in T-account form here. So when you're dealing with your governmental accounting, you have to be concerned with your account, or your title, your account titles here. So I've got them shown here in the T-account form. Okay, so for issuing this bond here, serial bond, we're going to debit our cash for $360,000 because that's what we're going to receive here. And let's just say it's issued here on January 1st of the year here. And then in our other financing sources, I've showed it as a liability account here, you're going to credit that here for $360,000. So this is where you have the special assessments for the bond issued. Now we're also going to have a semi-annual interest payments that I'm showing here at 10% annually divided by 2, so we got 5% interest payments semi-annually here. Okay, so that's what we have to do in our capital projects fund. Now let's move up to our debt service fund. Again, this is where we're going to be looking at the property owners are going to make payments to the debt service fund, and the debt service fund in turn is going to make payments required by the serial bond. So again, our debt service fund, this is where we're going to accumulate dollars to pay off our debt, and we're also going to be paying our debt through the debt service fund here. And we're going to be looking at the special assessment payments that are going to have to be made here to the debt service fund. The special assessment payments are being made by the property owners here. Okay, and we're just going to look at the first year here. So what we have to do here in our debt service fund, what we're going to I'm showing it again in T-account form. We're going to be looking at our receivables here, that special assessment, and then we're going to have to, what we're going to be looking at is recognizing our revenues here on that special assessment. And then along with that here, we're going to be looking at, based on our receivables, we're going to have, receivables going to be cash that would be coming in here. And then, well, it's going to be shown here in our cash account. So we're going to be looking at our cash coming in, and then for our cash coming in, we're going to be paying out that cash here. We're going to be looking at the cash going out as the expenditures. Okay, so let's start with our, and again, our debt service fund here. Let's look at our receivables. We have to determine, we have to break those apart between the current receivable here and the receivable that's deferred. So when we're talking about current, we're really talking about this first year that we're looking at here. So for our receivables, again, under a special assessment, debit that here for $90,000. Now that's at the issue date here, that serial bond here. And along with the debit, the $90,000, then we're going to recognize that as revenues here as a special assessment. We're going to credit that here for $90,000. And what we're really doing here when you're dealing with these governmental funds, you're looking at modified accrual accounting. That's where, again, governmental accounting, modified accrual here. This is where you cannot accrue any revenue unless it's available and measurable. So what we're accruing here, we're saying is available and measurable. Okay, so we've taken care of our current receivable here, debited it for $90,000, and recognized it as revenue as a special assessment here in our debt service fund here for $90,000. Now we have to set up our deferred. This is the remainder of that receivable here. Receivable, title it receivable deferred here, again for our special assessments, and that we would debit for $270,000. We have the total here of $360,000, and it's for 4 years, so we recognize $90,000 here for the first year. That would be the current portion here, $90,000. So the remaining $90,000 here from $360,000 is going to give us remaining receivable here as a deferred here amount of $270,000. Now that's at the issue date here, 1/1. Again, for the first year here. Then we would go over and we're going to credit the deferred revenues here, special assessment in our debt service fund here, credit it for $270,000. So we've recorded our receivables here. Just remember, you have to break it apart between the current portion here and the deferred portion, since we're dealing with some long-term debt here. Okay, so we've taken care of our receivable here at the issue date. No cash involved at that point. Okay, so our cash we collected, remember, in the capital projects fund, we collected $360,000 here. So now comes that first payment date here. Let's just say it at 6/30, semi-annual payments. So we're looking at semi-annual payments here in 6/30, mid-year here, and then 12/31, the end year here. So what are we going to recognize as revenues here? Receivables, well, we're going to take, for that first payment, we're going to credit or reduce our receivable current amount here by $45,000. That is that semi-annual payment here. $90,000 for the year here. The principal amount divided by 2 semi-annual payments is going to give you $45,000. Okay, so we credit, reduced our receivables here by $45,000, and then in our revenues, again, special assessment, we're going to credit that here for $18,000 for that interest expense. We had that total $360,000 outstanding here for that 6-month period, times 5% interest rate, half of the 10% here is going to give us $18,000 of revenues. We're going to be receiving those revenues here from the taxpayers that are being property tax owners that are being billed here for that new construction of the road here. So credit it for $18,000. Then we have to move up to our cash account for the debt service fund. Again, everything we're doing here is in the debt service fund. So looking at the amount coming in, that would be the $63,000. That was the $45,000 reduction here in our receivable credit to our receivable here for the current special assessment here, plus the credit here for that interest, that first interest payment, $18,000. So cash coming in, $63,000. We look at it in those terms based on our modified accrual accounting here and what the property owners would be paying in here to the city. And now we have to pay for that bond that serial bond here for that first payment. So we have the debit here in our cash account, $63,000. So we credit it out here, our cash for $63,000, and then the debit would go to our expenditures here, debt service fund for label principal and interest here, debited for $63,000. So that's at our 6/30 date here. Remember, the $63,000 here is that $45,000 reduction here in our receivable, our current amount, our reduction here, plus the $18,000 here that we have for the interest on that serial bond. So that is where we're getting our expenditures and our cash. Cash coming in, $63,000, and then cash going out here, and we're recognizing it as an expenditure here of $63,000. Okay, so we've taken care of that first payment here at 6/30. Same thing for the next payment here, end of the year here for that second payment here. Again, credit, reduce your receivable by $45,000, and then your revenues. This would be the interest payment that would be paid here by the property owners here. That would be, let's say, $315,000 left. We had a reduction here of $45,000 from the $360,000. We're left with $315,000 times 5% is going to give us an interest. It's going to be an interest payment, the semi-annual interest payment here, $15,750. So credit your revenues account here, special assessments for $15,750, and then go up to your cash account here in your debt service fund. Again, everything's done here. You would debit that here for $60,750. $45,000 reduction here in your receivables current, plus your revenues for the interest here, $15,750 for total here of $60,750. So there's increase your cash for that amount, then that would be the cash, the revenues coming in, or the cash coming in here from the property owners here, and then credit it out here for $60,750 for what you're going to pay on that serial bond here. So payments made to the serial bond or the bondholders here. Debit your expenditures here for the principal interest, again for $60,750, so $1,231. So you see what's going on here. We first had to set up our receivables, break it apart here between the current and the deferred portion, and then we looked at that first year here, what we would recognize as a receivable here for the two semi-annual interest payments. We reduced our receivable current portion by that amount, and then along with that we had to recognize revenues for the monies coming in here based on the interest payment that we're going to need here for paying off that serial bond for the first two payments here, mid-year and end of the year here. And then when we got that money, both for we recognize as our reduction in our receivables here, plus our revenues here for the interest payments, we recognize that as cash coming in here, and then we had to pay out the cash to the serial bond holders here. So we paid out the cash here, and then we recognize it as expenditures here, both what we reduced as our receivable here, the current portion, plus the interest. Here the interest was interest payments coming in. Here it would include the interest payments coming out. So there we would have debited, again, our expenditures for principal and interest. Again, this is everything's going on here in our debt service fund. Okay, so now let's go down and let's look at our general long-term debt account group. This is where we're going to record the unmatured principal and long-term debt. Again, remember the bond was issued here for $360,000, 4-year bond, had 10% interest rate, and serial bonds would be issued at their face value here. So this is where you have, what you have to do in your general long-term debt account group. This is where you account for the unmatured principal and obligation or debt. In this case, it's debt. So you want to look at your title here. This is what you have to do. You have to say the amount to be provided for these special assessments. So and then what you would do, well, let's look at that. Amount to be provided for special assessments. And then you're going to have, as your liability account, you're going to have your serial bonds payable for the special assessment. So this is where you get your bonds payable here. Again, that $360,000 bond that was issued here, debit your amount to be provided here of $360,000, and that's on the issue date here. And then in your serial bonds payable for the special assessment, credit that here for $360,000. So that's the serial bonds that are payable. Now, we come down here on each of those payment dates, 6/30 and 12/31. We reduce the amount to be provided because it's going to be provided. We're not going to have. We're going to be able to reduce it here by those the $90,000 principal per year here, 2 semi-annual payments for $45,000 would be the semi-annual here. Reduce or credit your amount to be provided here by $45,000, and then your debit is going to go to your serial bonds here because you're going to reduce your requirement here on your serial bonds by $45,000. So you can see here for each of those payments here. So you can see what's going on here in your general long-term debt group here. The principal, we're keeping track of that principal and we're reducing it for the principal that would be paid here on each of those semi-annual payment dates that we have here. So that's what's going on in your general long-term debt account group. Accounts for the unmatured principal of the obligation, and we were reducing that unmatured amount here. We'd be keeping track of the unmatured amount here based on our reductions. Okay, so you see what's going on here in your general long-term debt group. Okay, so maybe we better go just back over here and just review what we're doing here. So again, moving over to our capital projects fund. This is where we actually issued those bonds here as cash received. Again, title capital projects fund. We would debit it for the bond, face value of that bond issued, as serial bond here issued here for $360,000, and then we look at other financing sources here. Again, in the capital projects fund, we would credit that here for $360,000. So you can see we're keeping track of that total $360,000 bond in both our capital projects fund and then our debt service fund and also our long-term debt account group. So let's go back up to this debt service fund here one more time. Okay, so again, in our debt service fund, we have to keep track of our revenues here and our expenditures because we're going to be receiving monies here from the property owners based on that serial bond that was being issued here, and then the money that's received here by the property owners on that special assessment here is going to go and increase our cash account, and then our cash, we're going to pay that out here and recognize it as expenditures here for those serial bonds, both the principal and the interest. So again, this is the debt service fund. Just remember, in the case here, long-term debt here, you're going to set up your receivables. You're going to have to look at the current portion and break that apart from the deferred portion here. Again, using receivable deferred portion here for modified accrual accounting. Okay, so you have to set up your current versus your deferred portion here based on that total issue of $360,000 in bonds. So you can see here we had in our debt service fund, we have both a debit here of $90,000 receivables current, that's for the first year here, and then the remaining portion, $270,000 here for the deferred portion. So total amount here is sitting here at $360,000 on our receivables. And then of course, we had to look at our deferred revenue, set up our deferred revenues here. But the revenues that we actually, going into our debt service fund here, we looked at that first principal amount here, the current portion. We take the total first year's current portion here and credit it as revenues here. But then the other revenues that are coming in was the interest, those interest payments on the serial bonds that the property owners would be paying here. So we have to credit that or increase our revenues by the amount of those interest payments, and then total amount of our reduction here in our receivables, plus we have in our revenues here, the interest payment go into our cash account here, increase our cash account here, or debit our cash account, and then we have to pay out of our cash account here for the payment here of those on those serial bonds here. So reduced our cash account here, and then we recognized our expenditures here both for the principal and the interest amount here on that serial bond. So again, this debt service fund, this is where you're going to accumulate your dollars to pay your debt here, And in this case, we didn't just accumulate them, we actually paid our debt out of the debt service fund. We didn't transfer it into another fund. That could be done here, but we just, in this example, we just brought those funds in here and the dollars in, and then we paid out those dollars. Okay, so that'll summarize what we're looking at here on a typical governmental accounting here, where we had this special assessment and we had to deal with a serial bond. We had to make payments into the debt service fund and payments out of the debt service fund, and then we had to record in our general long-term debt account group. So just remember here, we can go down and look at it one more time. Remember, when you're with this debt service fund here, it's closely tied into the general long-term debt account group. So you have to look at that here. Okay, so that'll really summarize what our discussion.